Paul, good morning to you. I want
Morning.
to start with the incredible performance we've been seeing from the semiconductor industry. Jared, before the break, broke down what's happening with chip stocks. AMD, I think, at a record high, following stronger than expected earnings yesterday. How exposed are you right now to chip stocks?
And good morning again. My son Ryan will be ecstatic because the only stock he loves day in and day out, week in and week out, has been AMD. So, and
How old is
listen,
your son?
AMD, two huge pieces of news. Semiconductors are among our two biggest positions, and they've been that way. I think now we don't hold stuff all that long. I think we've had semis now for the last 2 years. So the size of the position continues to change, but we have a very healthy position in semis. And I think they're on balance going to go higher. Could they pull back, 5 or 10%? That's a 2-day move these days in semis. But on balance, I think through the end of the year and into next year, semis will be a place to be.
Paul, we're all going to get ready to watch big tech testify down in DC. Lots of Robinhood traders are going to be all stuck to their screens watching these testimonies here. Do you expect a selling wave in some of these big cap tech stocks, like a Facebook, like an Apple, after this testimony? I think lawmakers are going to bring up some very, very valid concerns, which calls into question future earnings power of these companies.
So, Brian, and you also have earnings. Let's not forget that. A lot of these big tech companies are right about to report earnings. Tech has been looking for an excuse to sell off. My theme I've written on our blog for the last days and weeks about this insane period of outperformance by large cap tech coming to an end. Doesn't mean large cap tech has to unleash a selling wave, but I think there is an excuse out there looking to sell some tech. I'm just, as we were coming on, I was finishing up my blog and I said, large cap tech's reporting a lot of volatility. It's not so bad if large cap tech stops going like this and goes sideways. That'd be healthy for a while. It's got to catch up with the fundamentals. So could we see, so we know this, Congress is not going to be pleasant to large cap tech. They're going to jawbone. It's an election year. They're going to want people to know they're fighting for the little guy, blah, blah, blah. So I'm in the glass is half empty side in large cap tech right now.
All right, guys, I want to move away from tech for a minute, take a look at autos, because we heard from GM this morning, Brian Sazi, they swung to a loss last quarter. I guess no big surprise, all the factory shutdowns due to the pandemic. We're starting to see signs of a recovery there. I know you were on the earnings call earlier. What were some of the big takeaways for you?
Yeah, Alexis, media call before we went on with Divya Suradevara. She's the CFO at General Motors. Two takeaways. One, confirmed that GM has fully exited their stake in Lyft. They exited that in the second quarter. Remember that they took a $500 million stake in GM, somewhat famously, not in Lyft, in 2016. So they are out of that. Second of all, there was a sense of optimism on the mind of Divya. They're looking for an economic recovery in the second half of the year, up to $9 billion in operating cash flow that will help them pay down their debt. But key to that, I think, is that you see COVID infections start to level off. And it's just really unclear right now if that will be the case. And if that does happen, how do they pay down all this debt?
Yeah, great question. Paul, what do you say to that? And how exposed are you to autos? And among them, who do you think's best positioned right now?
We have no exposure to autos, and it's not because I have some cataclysmic view of autos. I think that I think they're somewhat in the have-not category. They have to put up before I'm gonna commit capital to them. GM. I was a little surprised that GM was up in pre-market. I didn't view the whole package as being all that great. I think people playing catch up. The pent-up demand from the recession. Things are getting a little bit better, but the auto stocks trade like most of the other super sensitive and cyclical stocks. And I think they've got a headwind. They've got a headwind in that the consumer, we don't know what's going to happen with the congressional package. I don't think the economy is going to fully recover. And I've been so positive for so many years. I think you've got years to come, and I don't think you'll see unemployment at the level we saw in January in my lifetime. So I think there are headwinds, and for me to buy a GM or a Ford, and I won't include Tesla because I don't think it's really an auto company, but I think I would need to see some better either a tiny bit better fundamentals and a lower stock price, or amazingly better fundamentals and a stable or slightly higher stock price. And I don't think you have either one right now.
Paul, I got to ask you about the dollar, because the Dixie is making fresh multi-year lows. Euro is very much gaining on the dollar, but also broad weakness. But the dollar could be at an inflection point, being very much oversold. How does that fit into your general macro view here?
You know, most people don't bring up the dollar until it's at incredible extremes. And I remember turning positive in the dollar in the middle of 2008, right before QE started. The dollar's great at anticipating stuff coming down the road, whether it's bottoming or putting in a peak. Right now, everyone's asking about the dollar because gold has soared. So, and Bitcoin has soared as alternative currencies. I think you're right. I think you're at an inflection point, and I think some real dumb money has come into gold and that momentum area, and that usually happens right near a peak. I'm not saying the dollar is going to bottom today and gold's peaking today, but I think you're closer to some kind of intermediate term peak in gold and an intermediate term bottom in the dollar. Also with the dollar, it is the single biggest area sector investment where there's the most misconceptions, like, well, if the dollar goes up, stocks have to go down. If the dollar goes down, stocks have to go up. It only works when it works, and then everyone talks about it. But a lot of times, it doesn't work at all. I mean, the first quarter of 08, the dollar collapsed and stocks collapsed. So it depends on the environment you're in. I mean, clearly, the dollar has been under pressure. I think long term, let's say that the rest of this decade, I think you can buy dollar weakness. But I was on with you guys several times about loving gold. This is the point where you pull some chips off the table in gold, not go all in.
Yeah, I was going to ask you, just because the weaker dollar has forced a lot of folks to run to gold. It's up about another 0.5% today. So if you're on the sidelines and not in gold right now, I mean, you're talking about taking some chips off the table, but if you're on the sidelines and you want to get in on what's happening in the gold market right now, is it just too late?
Depends on your time frame. So first of all, we started buying commodities, the GSG and DBC as a broad basket a couple of months ago, and I think that theme will continue. But specifically to gold, because gold's part of the commodity basket, I think at the end of these moves, you see a lot of volatility, and that's when you can get hurt the most. So if I was sitting on some money and I wanted to buy gold or the gold stocks, the GDX or something of that nature, Newmont Mining, I look for a pullback, a 5 or 10% pullback. Not that there's some magic number where you're going to bottom, but buying it after this historic run to all-time highs. You've got everyone in the media, all the pundits are talking about it. That's normally a recipe for some kind of peak pullback, sideways consolidation in the metal, and in any security, frankly, when people get that excited about it.
Staying on the industrial complex, Paul, I put out a tweet this morning, somewhat jokingly. What would you rather do? Spend $9.99 on a Spotify premium subscription, or spend about $7 on one share of GE? I'm sure you saw the quarter out of GE. It was another really, really tough quarter. What's your assessment?
So you're right. And I laugh. Listen, 20 years ago, GE was the stock. It was the Apple of that era. And now it's, I'm looking at it, it's $6 and change. I mean, how the mighty have fallen. So GE, they're probably in, if they're going to survive, which I think they will, they're probably in this long-term bottoming period where it's going to take several management changes. I mean, I've said people used to laud Jack Welch, Neutron Jack. I thought it was the beginning of the quasi cooking the books era, and I thought Immelt was really incompetent. So now it's taking so many groups of management teams in there, and they're still trying to turn the company around. Maybe it's a 2022 story, but for my money, it's not a 2020 story, and even first half of 2021 story. No, thank you.